Okay, so for today's topic, my presentation will revolve around the Asian markets in terms of where are the risks and opportunities during these current times of volatility. So as Ethan has mentioned, some of the focus that I have will be on Japan, of course Singapore, and last but not least, the China outlook itself. So without further ado, I'll just jump straight in. Some of the disclaimer before I provide the presentation is that this content of the presentation is mainly for educational and informational purposes only. Of course, it does not in any way constitute any form of investment advice. So if you have any, if there's any buy or sell call, generally it's just my personal point of view, and do please perform your own due diligence. Okay, so this is me. I joined IG in 2021, but before that, I'm actually a US research analyst. So I was looking at the US markets. Before now, I'm moving towards a more broad-based range of topics, ranging from commodities, FX, and also the Asian markets as well. And of course, if you have any question on the US markets, I'll be glad to answer them as well. So just put it down into the question tab. Do also follow me on Twitter. My Twitter handle is at @Yeap_IG. So as and when almost every day, I'll be posting some updates on some of the economic data and also some of the technical chart that I'm personally looking at. And if you have a Telegram, I know that Telegram has been very popular among Singapore. But if you have also a Telegram, you can also join this Telegram group. The name is called IG Asia. So as and when we will be posting a very insightful articles and also some of the content on a daily basis, just to provide you with the latest update and insights. And last but not least, the administrative part. We actually have this Volatility Bloomberg ebook. It is absolutely free. So if the previous speaker has also talked a lot about this volatility. So if you have just if you're interested, you can just take out your phone, snap this QR code. It will actually bring you to the link for this ebook. So it's totally free. It provides a very huge, extensive content on how to trade with volatility, which I believe is very, very applicable, especially in the current times. So probably I'll just leave it here for just maybe 10 or 20 seconds. So if you want, you can just just use your phone to snap down this QR code. Okay, so with that, I'll move on to the content proper. So today's content is largely revolving around the Asian markets. So we'll just take a very quick snapshot of how the various markets are performing from 2020 to date, namely from the COVID-19 period. So we have seen some of the index that has been outperforming, whereas some like the Hang Seng has been kind of under immense pressure lately. So the valuation has been hit to somewhat of a record low in terms of the price to book ratio. So it really brings the question of whether they still provide a long-term value proposition. But in the short term, there are definitely risks to watch out for. I mean, Hang Seng is still way on by the technology clamp down that front, along with all these macroeconomic risks that has been weighing on all these risk sentiments. Of course, we are seeing somewhat of a recovery lately. Whether it can actually mark the ultimate bottom. Personally, I believe that still remains to be seen for now. But in terms of the Asian market, some of the indices that has been pulling ahead, we have at the top of the chart, we have Nikkei and the CSI 300. And of course, the CSI 300 is largely because they actually experienced a lesser sell-off from the COVID-19 period due to their more prompt and I would say more prompt and aggressive measures in containing the virus spread. So they actually experienced a lesser sell-off, they experienced a greater recovery, but thereafter all those kind of regulatory risks and the zero COVID-19 approach weighs in, and that kind of leads to them giving back some of its gains. Ultimately, if you look from 2020 to date, they are still somewhat one of the top performing indices in the region itself. Of course, trailing somewhere in the middle, we have the ASX and also the STI. So this is just the MSCI Asia Pacific Index versus the S&P 500. So generally from the COVID-19 bounce, both has been on a recovery track, largely in line until around 2021, where the relationship, where the gap seems to be diverging somewhat. So for now, it does seem that if we were to able to see S&P 500 potentially going down, that may also weigh down on the MSCI Asia Pacific Index as well. But the key thing is that generally they hasn't been seeing that much of an upside as compared to the US markets. So hopefully, if we are able to see a sell down on that front, generally it could be tends to be more limited in terms of the downside risk as compared to the S&P 500. But definitely we will have to watch for a turning point on that front as well. But just to say that, you know, even though the relationship tends to go hand in hand, but the relationship, that gap has kind of widened. So the MSCI Asia Pacific has not been tapping as much upside as the S&P 500. So when there's any kind of a moderation taking place, hopefully we are able to see somewhat of a limited downside on that front. So on the broad economic picture, two indicators I'm looking at. Of course, one, the whole story is on the inflation. The other is on the trade-off for growth, which comes with the fight against inflation, right? So just to provide a kind of a key broad overview of where the various economies are currently standing, why I look at it is because this actually presents to you, you know, which are the countries that actually see somewhat of a lesser pressure in terms of a tightening, and also in terms of their growth outlook. So of course, we will want to, you know, lean towards those countries which can still maintain somewhat of accommodative policies. They are not under, you know, the intense pressure to have to aggressively tighten their monetary stance to curb inflation. And that is also, you know, provide them with an added tool to boost growth if ever needed. So if we look at the consumer inflation rate at the left-hand side, we can see that generally in line with the global picture, most economies have actually have their inflation rate towering above their target rate. So you can see the red dot is actually the inflation target rate from each of the central banks, whereas the blue bar is the current consumer inflation rate. So generally, most economies have been towering above, which just means that, you know, if you have your consumer prices above your current inflation target, it just means that you will have to aggressively tighten. And for example, we have seen Singapore recently just having multiple the second off-cycle tightening whenever they have any upside surge in terms of inflation. So that is what has been limiting their policy approach. And we know that when there's any tightening, it does have a trade-off effect on economic growth itself. But on the other flip side, you can see Japan, generally we have inflation aging above its inflation target, but generally it's not somewhat of a huge surge ahead like we see in the US. And of course, China aging up as well, nearing its inflation target, but still somewhat trending below. So what this means is that it gives them the room for them to implement a greater accommodative policy if needed. But recently we have seen that they are slightly more prudent, slightly more cautious. I believe that potentially they are waiting for the economic reopening from these various easing of virus restrictions to take place, which could boost growth. But if not, you know, potentially we could see some of those easing measures coming into play as well. So Indonesia also roughly in line, consumer inflation rate along with its inflation target. So these three countries, you know, tends to have a lesser pressure in terms of its tightening stance. And on the other side, on the right-hand side of the chart, we can look towards the GDP growth. Of course, it seems to be quite healthy, namely because many of these economies were kind of late in terms of reopening their economic restrictions to the COVID-19 virus itself. So there was kind of a delayed recovery from the pandemic front. On the top of the chart, we are looking at, of course, India, Vietnam, these two countries, whereas on the other bottom, still somewhat of a growth picture there. We have Japan and also South Korea. So just want to bring your attention to, you know, when we look at MSCI Asia, when we look at the Asia region, what are some of the factors that could come into play? And this is a chart that I have, which namely plot the Asia Pacific Index together with the US dollar index. And you can see that it generally tends to have somewhat of a negative correlation. So this red line itself is actually the inverse of the US dollar index. So you can see that it somewhat goes hand in hand with the Asia Pacific index itself. And of course, some people may choose to remove Japan. You know, they tend to look at the MSCI Asia Pacific X Japan to have a better picture of the conditions in the emerging markets in Asia. That is totally fine as well. But even if you do that, you can see that the correlation tends to stick. So this is just inclusive of Japan. The correlation maintains as well a negative correlation picture that we have. So what this means is that if you were to have any more sustaining upside in the Asia economic picture, generally we have to see somewhat of further retracement in the US dollar index just based on this relationship itself. So of course, if we look at the US dollar index, generally it is still on an upward trend, right? How do you see this is through the series of higher highs and the higher lows being formed. You can actually draw a very, very well-placed upward trend line here, connecting a series of these higher lows. So the general upward bias, I believe, currently it still remain intact for sure. But what we want to see is really somewhat of a sentiment shift. And if we were to see somewhat of a sentiment shift in the US dollar index, generally it may translate to, potential some traction towards the Asian market itself. And why is this so, right? We know that, a weaker US dollar could help reduce some of the foreign exchange debt stock or even service burden for these Asian economies, which has generally increased their US dollar debt over the past decade. So if you were to see a weaker dollar, generally less pressure for these emerging Asia economies. And of course, if you look towards a more attractive exchange rate against the US dollar, that could also help some of the emerging markets attract capital inflows back into their country. So generally, if we talk about a weaker dollar, the Asia Pacific region tends to benefit as well. So for now, as I mentioned, we may have to see somewhat of a shift in the sentiments. And where am I looking at? One is the upward trend line that has been drawn here. And second will be the recent Fibonacci level, if you draw from its previous bottom to its recent peak. So generally, you can see somewhat of a confluence in that aspect in terms of the upward trend line and also the 50% retracement level, which is kind of around the 10,400 and 104 probably 104.5 around that region. Probably I need to turn to the chart, but you can see that this is somewhat of a confluence of a region where these two tends to come in line. So that could provide somewhat of a very strong support at that point. So if you were to see somewhat of a break below this level, that could mark a starting shift in the sentiments, and that could translate to some traction towards the Asia markets. So that could be one that you may want to watch. So moving on, I'll be talking about Japan's outlook. So generally, when we talk about Japan, probably I'll just switch the focus a little bit towards the US first. So recently, we have seen the relationship between the US 10-year Treasury yields and also the US tech sector itself. The relationship has not been very prominent over the past 10 or even 5 years. It only got more in line across the past 1 year itself when there was talks of tightening kicking in. So generally, when people talk about the increase in 10-year Treasury yields, they tend to think of it as a higher cost debt for many of these growth sectors. And when we talk about growth sectors, that will revolve around the tech companies itself. So over the past 1 year, there has been somewhat of a more aligned relationship between the 10-year Treasury yield and also the technology sector itself, as you can see from this chart. So the blue line is actually the inverse of the TNX. So mainly I look at the TNX as a gauge of the 10-year Treasury yield index. And of course, the orange line will be the Nasdaq Composite. So this relationship has been playing out so far. There hasn't been somewhat of a shift yet. So hopefully this could still remain the ongoing theme over the coming weeks. And why I'm looking at this is because Nikkei, generally the top two sectors that accounts for the largest weightage in the Nikkei. One is the tech sector. The other one is the industrial. So these two actually comprises a huge percentage of the Nikkei's overall percentage weightage. So if you were to see this relationship between the Nikkei and also the Nasdaq, it tends to go hand in hand as well. So if you were to see any downside in the Nasdaq, generally it will translate to downside around a weakening outlook for the growth stocks, and that also weigh in on the Nikkei in the Asia session as well. So generally this relationship tends to go hand in hand. So I would say that if you were to see any form of traction in the Nasdaq index, that could translate to some near-term upside for the Nikkei as well. So with that, if you look at the US 10-year yield, This is just the chart of the TNX. Generally, I'm looking at a head and shoulder pattern. So you can draw a perfectly left shoulder on its recent peak of the head, and then followed by the lower peak, which forms its right shoulder. So it really begs the question of whether we could see somewhat of a breakdown. And I think I prepared this chart a few days back, and over the past few days, I think we have been seeing somewhat of a downside pressure on the 10-year Treasury yield. So this could mean that, if you were to see a break below this head and shoulder pattern, that could mean that, this pricing of a recession risk has been taking control, and we could potentially see further downside in the 10-year yield, and that could ease some pressure of the tech sector, of the growth stocks itself, which could provide an uplift for the Nikkei index. So for some of the catalysts that I'm also looking at for Japan, that the accommodative policy seems to remain in place. Previously, there has been some market watchers which are seeking to challenge its accommodative policies by, trying to challenge their yield curve control policies. And we see the authorities pushing back by delivering an unlimited bond purchase of its 10-year bond. So they are very firm. They are sticking to their easing policies for now. And recent meeting, they have clearly indicated that they have no intention to shift away from their stance anytime soon. And of course, with these quantitative policies, it tends to be, more forgiving for the economic front itself. And in terms of some of the challenges, there were some concerns that, because Japan is an oil importing country, there are some arguments that with oil prices being high, they could eventually be forced to, tweak their weak yen story in order to cope with these higher importing costs of energy. But recently, we have seen that recession fears seems to be putting a cap on prices upside for now. So that kind of translates to some easing pressure towards Japan, in that they actually has further room to maintain its accommodative policy in place. And the second point will be the breakdown of the US 10-year yield, and of course that could provide some tailwind for its tech composition, in my personal view. This is just a chart to show the Brent crude. Of course, we know that the ongoing tight supply situation still persists for sure. But generally, with each higher peak that we have seen in the oil prices, if you take a look at the CFTC net long position among money managers, we are actually seeing a new lower lows presented lately. So how do I look at this is that, these money managers could potentially see a lesser conviction with each oil prices rally, especially with some of the uncertainty over growth, uncertainty over recession. So it tends to mean that, they are being more cautious and wary on whether, a recession risk could really, took control of oil sentiments and override some of these tight demand supply imbalance situation. So this is what has been in place, the lower high and the lower low that has been presented on the CFTC net long position among money managers. So I would say for oil prices, it is still somewhat of a very huge black box, because of all these growth risks that has been coming into play that could potentially put somewhat of the upside. But of course, on the downside itself, we know that the ongoing tight supply situation could continue to underpin. So it's somewhat of our belief that it could continue to trend in somewhat of a consolidation phase over the coming months. Okay, and when we talk about the US 10-year yield, the other asset that I'm looking at will be the dollar yen for sure. So we know that one of the key driving force behind this dollar yen currency pair is the yield differential, right? So with Japan sticking to its yield curve control policies, that kind of creates an anchor for the Japan 10-year bond yields. And of course, if you were to see this increasing US 10-year yield, that translates to a widening yield differential, and that has been one of the key tailwind that has been propelling the dollar yen over the past year itself, as you can see from this chart. So if we were to see somewhat of a downtick in the US 10-year yield, as rate hike bets from the Fed start to ease a little bit, as the Fed turns to be more data dependent. If we were to see further downtick in the 10-year yield, that may translate to a somewhat of a lessening of this yield differential, and we could see some downside for the dollar yen if that plays out. So over the past year, there has been a very strong net short positioning in yen. Of course, that market watchers are maintaining that the Fed will continue its stand to be aggressive, whereas the Japan central bank will be more accommodative. So the kind of a policy divergence has translated to a lot of short positioning build up in the yen. So for now, it seems that there has been some of a easing over the recent weeks, as you can see from this chart itself. But generally, it still trends around quite an extreme level. So that means that it can allow room for a reversion if eventually a yield differential start to ease over the coming months. Okay, so this is just the chart on the dollar yen itself. Generally, what I'm looking at is some of the ascending channel pattern in place. So you can see that yesterday's move actually bring a retest of the lower channel trend line itself. So it is really at somewhat of a mid or break zone. If you were to see a breakdown, I believe that that could actually draw much further downside, potentially towards the 126 level over the longer term. So that would definitely we want to watch if this lower channel trend line support actually holds. Okay. Next one will be the Nikkei. So I mentioned that if you were to see some of easing USU, some traction towards the tech sector, hopefully Nikkei can find some tailwind from there. But if you look at the Nikkei 2 to 5 chart, it has largely been trading on a consolidation period since October 2020. It has bouncing between this range. So for now, what I'm looking at will be the 28,400 as a potential resistance. And this is where we can see from the chart that the previous 2 peak actually was formed. So the buyers didn't manage to break past this level on 2 occasions. So for now, there may be a retest of 43rd time, which could increase the chance of an outward break. But we have to see this break of the 28,400 level in order to bring further upside potentially towards the 30,000 level next. But generally, if you see across the past week, it has been bouncing within this range itself. So it's kind of a ranging pattern playing out. So one of the strategy that you can employ is also if it retests the 28,400, which is the top range of the consolidation pattern. If it didn't manage to break through, it formed somewhat of a bearish setup, bearish candlestick from there. You can actually play with this consolidation zone by having some of a short position and then potentially take profit when it reach around the 27,000 level or even the 25,900 level, which marks its bottom of the consolidation pattern itself. So this is what you can actually watch out for. Okay, now my attention will be brought to the Singapore market. So for Singapore market, the STI, we know that we will have the bank earnings next week. So that will be a very key component to watch, considering that banks actually account for 45% of the STI index. So when I look at the STI, we actually have this very good indicator, which is the net institutional fund flow, which is uploaded by the SGX every Monday. So it really provides a very good picture of where institutional investors are, whether they are coming into the STI or they are actually de-risking. So you can see that over the past 1 year, it seems to play out somewhat relatively well. So you can see the red zone, which I marked it up as periods whereby we are seeing institutional net outflows. So we see that in November and December of 2021, and with that, the STI was kind of a weak. We are seeing a strong sell-off from there. Before things starts to pick up around January, February this year, where we see some kind of inflows coming in. So that kind of propelled the STI towards the 3,400 plus level and forming a new recent peak. But from March onwards, there has been an ongoing outflow. And when we talk about ongoing outflow, it could be a period of a distribution, right? Whereby the institutional investors are kind of de-risking. And it's really the retail that has been picking up all this long position. So I call it a period of a distribution, and that has been playing out from roughly March, the period of March onwards. So it suggests that the institutional investors are already positioning for this tightening economic conditions outlook way ahead, at the start of the year already. And for now, we are looking for any signs of inflows. Recent week, there has been somewhat of an inflow with the improved risk sentiment on the global picture, but the amount, the extent of inflow, I would say, is not that significant. If I'm not wrong, it's around 90 plus million Sing dollars. If you look compared to the previous months of the heavy outflows, it definitely trailed in a comparison. So that is definitely not improved sentiment, but whether it forms a more sustained upside, I believe that we have to see a more net inflows coming in from these institutional investors to provide somewhat of a greater confidence that risk sentiments could sustain. But for now, everything is still hugely a mixed picture. So this is just another chart to show you that the divergence between the institutional fund flows versus the retail side. So the red bar is the retail, and is upward sloping, meaning that it has been the retail investors that has been buying into the STI, whereas they are being sold by these institutional investors, which is marked by the blue line. So there is somewhat of a divergence, which I see as a form of a distribution. And whether we will see a turning point, definitely we will have to see over the coming weeks on whether it really marks somewhat of a turning point from there, in order to suggest that the STI is really in for a more sustaining upside. So if you break it down by sector, of course, the key highlights around the STI is the financial sector, right? Because the three local banks actually account for 45% of the STI index itself. So we will have to see somewhat of an uplift in the financial sectors in order to provide a boost for the STI index. And for now, we have been seeing a very strong outflows from the financial sectors from the early start of the year, from February onwards. But recently, it has been somewhat hovering at a consolidation over the past weeks. So generally, I believe that we will have to also look towards somewhat of a turning point for this yellow line itself to indicate a further shift in the sentiments towards all these local banks, and that will have somewhat of a propelling impact on the STI. So it's largely a wait and see around the Singapore market for now, even though it has recently formed a new higher high. But whether it really kind of marks the eventual bottom, I believe we will have to wait for data over the coming weeks to deliver a more conclusive a take from there. So for the STI, recently, along with the improved risk sentiments, it has actually marked a break above the 3,200 level, which was previously seen as a very strong resistance. So having a break out of this level and above is the 100-day EMA, kind of marks towards a very optimistic picture for now. So the next level that could be tested may be the 3,270 level. So that kind of mark is a previous peak that we have seen back in October 2021 and also recently in the early part of 2022. So 3,270 will be the level that I'll be watching out for any retest. And last but not least, I'll be touching on the China's outlook. Of course, the ongoing theme for China will be the economic recovery that has been taking place, but it's still facing some of headwind in terms of intermittent virus restrictions having to come into play as long as they were to stick to their zero COVID-19 policies. But for now, if you look at the economic data front, things are somewhat turning for the better. Some data that we can look towards on their recent retail sales, fixed income, and also industrial production. So as some restrictions start to ease, we are seeing a recovery in the economic activities. So we are seeing a pent-up consumer demand playing out on the outperformance in the retail sales over the past 2 months. And we're also seeing an improvement in the industrial production, so some growth right there. And if you look at the chart on the right, generally the inflation picture for China has not been towering above their central bank target yet of roughly 3%. So recently the CPI is still hovering around the 2% mark. Of course, you can argue that this is generally because the restrictions are still kicking in, and that kind of still put a cap on some of these consumer demand picture. But generally what this means is that, at least for now, there is definitely room for a further kind of accommodative policies to take place but it will largely revolve around the virus situation. So the China previously has mentioned that liquidity conditions are definitely healthy. It doesn't see much of an impact if you were to cut rates further. And I believe that the overall theme will continue to revolve around the virus economic outlook. So we will have to see a clearer path out of that in order for markets to really have a greater confidence in jumping back into the Chinese equities itself. Okay, so I'm looking at the Nasdaq Golden Dragon China Index. This is the monthly chart. So on the monthly chart, generally over the past 2 months, it has delivered some of a positive signal, and this is the bullish pin bar candlestick that are in place. So we actually see a follow through last month, but this month things starts to get a little more jittery, and we are seeing these sellers are coming back into play, trying to push, trying to overcome the previous month follow through bullish action. So for now, it really depends. The bullish hammer candlestick is still in place, so it does suggest that the deep buying efforts could still continue to take place. But of course, as long as these bullish hammer candlestick are sort of being overcome, some of the level that I'm watching will be around the 6,300 level, because I believe this is where we are seeing a previous support level taking place back in from 2014 to 2017. And recently, there has been 2 attempts to try to push below this 6,300 level, and it was eventually met with a huge, massive deep buying, which leads to the formation of this bullish hammer candlestick. So this 6,300, I believe, will be a very key levels to watch. And for now, it does seem that there's still some bearish pressure taking place. So hopefully, I will have to see this 6,300 level being supported in order to suggest that a greater confidence that a near-term bottom is being marked. So for the Seng Index, what I'm drawing here is the ascending channel. Likewise, sentiments are still somewhat leaning towards the downside. We are seeing a consolidation along this lower trendline support. And generally, when you see a consolidation at a support level, it doesn't box well, right? Because it means that the buyers has issues, trying to provide some sort of a buying power at the level of support. And if you were to see a consolidation followed by a breakdown, it suggests that the sellers are in control for now. So this ascending channel has actually given way. So it suggests that there could be a near-term downside ahead. And last but not least, if you look towards the China A50 index, this descending channel is also in place. It marks a series of lower highs and also the lower low. So previously, I'm looking at this 14,000 level, because I believe that this actually marks a very key level of support where a previous resistance is in place. It was actually broken back in June, July period. It forms a support, so it's kind of a resistance has turned support level, and it kind of coincides with a Fibonacci level, the 38.2%. If you draw from the, as you can see, we draw from its latest previous peak to its all-time bottom. So generally that has given way. The 14,000 key level has now given way. So the next level I'll be looking out for will be the 13,300 level. And this is where the next 23.6% Fibonacci level seems to coincide with the lower channel trendline pattern. So that will be one to watch on whether we could see somewhat of a bullish move from there. But looking at this descending channel pattern, any move to the outside could still be a shorter move until we are able to see a greater formation of a new upward trend. For now, everything still remains out towards the downside. Okay, some of the key risk factors that has really been putting a cap on all these Chinese equities, which I believe that we may have to see all these risks being addressed in order to create a greater market confidence back into Chinese equities. Of course, number one, we have seen them maintaining their zero COVID-19 stance. So what this means is that we will have to see markets adjusting towards this on and off economic restriction measures. So that is a huge part of uncertainty there. We are seeing somewhat of adjustment there in terms of, when we see virus cases coming back in, the markets has kind of reacted to the downside, but the extent is definitely not as much as compared to the start of the year itself. So it suggests that there is still some lingering optimism that yes, with all these strict restrictions, generally it can avoid the situation that we have back in April, where we are seeing a strong surge in the cases. We are seeing an out of hand virus spread, which kind of leads to a more aggressive lockdowns. So for now, the extent of sell-off is lesser, but it doesn't mean that markets are still very confident. They are still somewhat cautious. So we may have to see more struggling away of this virus risk from the market itself in order to provide greater confidence that this COVID-19 risk could be potentially be put at the back seat. And another thing we can look towards is whether the government has seen any shifting in stance. We have seen them trying to ease on the travel restrictions a little bit, but they have still maintained its a very strict COVID-19 stance. So this will continue to be somewhat of a key headwind for risk sentiments until we are able to see markets really struggling it off in terms of this if we were to be able to see somewhat of an upward move despite these increasing virus cases. That could be one of the positive signs that we can look out for, but generally that hasn't played out yet. The next one will be in terms of regulatory risk. I believe that the regulatory risk, in my own personal view, has been somewhat priced to a large extent. Previously, we are seeing regulations coming in, but over the past few months, we are seeing lesser of newer regulations. We are seeing more of fines kicking in. So this suggests an adjustment process kind of taking place. And if you were to ask me, I will lean towards the stand that we could be nearing the later half of the regulatory reforms process. So we are seeing more and more fines coming in, which I believe, when we look at fines, it tends to be one-off. And we know that many of these big Chinese tech firms, their profitability can easily offset all these fine amounts, based on their 1 year revenue. So if I were to look at fine, generally it is the least form of a punishment, the least severe form of punishment as compared to longer lasting kind of regulations reform kicking in. And over the past few months, it could be somewhat of a positive sign in that reforms are slowing to a larger extent, and it's just fines are replacing this punishment. So I believe that we could be pricing towards the regulatory risk the later half of the reform period, but it's mainly the key risk will still remain on the COVID-19 itself. And last but not least, global risk sentiments will have a key part to play. Even though we are seeing some of a divergence between Chinese equities and also the US in recent months, in that if you look at the Hang Seng Tech Index and the Nasdaq 100 Index, the correlation has not been that well in that, if we were to see outside in the Nasdaq 100, the Hang Seng Tech Index actually see somewhat of a downward pressure. And previously, when Nasdaq was having a very strong sell-off, we are actually seeing some traction back into the Hang Seng Tech Index. So if we were to be able to see further divergence, that could be a positive sign that the Chinese equities could be breaking away its influence from external factors. But we will definitely have to see about that. I believe that all these key risk factors are still in play. We may have to see markets reacting better to these risk factors. And for now, based on the technicals, it does suggest that sentiments are still largely way, and the technicals are still pointing to some of a downside over the near term. Okay, so with that, I've come to the end of my presentation. So if you have any questions, please feel free to just type in the question box, and then I will just look at the question box and try to answer from there. Okay, there has been one asking on the QR code for the Bloomberg ebook. Yep, sure. Just give me a moment while I just navigate towards that. Okay, so this is the QR code that will bring you to the Volatility Bloomberg ebook. So a great wealth of information there. And some of the questions. Okay, one is the dollar yen chart. Okay, asking on whether there's a divergence on the RSI. So let me just navigate to the dollar yen. Okay, so if you look at the dollar yen, yes, previously there has been somewhat of sorry, let me get these slides back up. Yes, if you look at the recent dollar yen, you are right. There has been somewhat of a bearish divergence taking place, which leads to the recent strong sell-off. You can see not just on the RSI but also on the MACD indicator. You can see this downward trend line, connecting this series of a lower high. Whereas if you look at the dollar yen chart, it's actually forming a higher high. So this is what we call something a bearish divergence taking place, and that was actually met with some near-term retracement. For now, it's really retesting the lower channel trend line. So if we were to, we have to see whether it eventually holds. If you look at the candlestick over the past two days, it does suggest that bearish pressure are in place. So you can see a very huge bearish engulfing, which seeks to overturn, 4 days of gains, and then which was actually followed through with another strong bearish candlestick with a very long body. So it does suggest that bearish pressure are kicking in. So we can look towards, any potential breakdown of this channel pattern itself. Okay, let me just take a look at the other questions. Okay, so there's these questions. What do you think about the property market risk in China? Yes, that has definitely been one of another lingering risk. So we know that there has been these mortgage boycotts going on, which really deliver it could have a very claustrophobic impact on the economy, considering that for China, a lot of the wealth are actually locked into the property market. So, if you were to see a huge downturn on that front, it can generally translate to a huge economic risk towards the overall China growth picture. So that is definitely another risk that we are all watching. We can see the authorities are trying to mitigate some forms by asking the banks to ease their lending a little bit. But generally, that is another lingering risk that we can watch. So, as long as all these risks start to persist and we are seeing the downbeat mood around the Chinese equities and also on the technical front, I believe that could lead to somewhat of a further weighing on Chinese equities for now.